Buying insurance is a crucial financial decision. It protects your assets, your family, and your future. You rely on insurance agents for guidance and access to policies. Understanding how your agent is compensated is key to being an informed consumer. It sheds light on the insurance transaction process. This knowledge helps you evaluate advice and compare options effectively. Transparency in financial relationships builds trust. Knowing how agents earn their living demystifies part of the insurance industry. It empowers you to ask better questions. This discussion aims to provide a clear, analytical look at agent compensation. We will break down the primary methods agents use to earn income. Our goal is to educate you, the insurance buyer. When you pay your insurance premium, a portion of that money goes to the agent. This is not an extra fee added on top of your premium. The commission is built into the cost of the policy itself. The commission structure aligns the agent's income with the policies they sell. The more policies an agent sells, and the higher the premiums of those policies, the more they typically earn. This is the fundamental model. This system is standard across many sales industries, not just insurance. It incentivizes agents to connect customers with insurance products. It is the engine driving the distribution of insurance policies. There are generally two main types of commissions agents earn. These are new business commissions and renewal commissions. They are paid at different stages of the policy lifecycle. New business commission is paid when an agent sells a brand new policy to a customer. This is often the largest commission payment for a given policy. It rewards the agent for acquiring a new client or selling an additional policy. Renewal commission is paid each time a policy is renewed. This happens annually for most property and casualty policies. Renewal commissions are typically a smaller percentage than new business commissions. Renewal commissions provide agents with ongoing income as long as the policy remains in force. This incentivizes agents to provide good service. Good service helps retain clients and policies. Commission rates are not fixed across the board. They vary significantly based on several factors. Understanding these factors helps explain differences in agent earnings. One major factor is the type of insurance policy. Life insurance policies often have different commission structures than auto or home insurance. Health insurance and commercial insurance also have unique rates. Generally, policies with higher premiums or more complexity might have different rates. For example, a complex commercial policy might yield a different commission than a standard auto policy. This reflects the effort involved. The insurance company paying the commission is another key factor. Different insurers offer different commission schedules to their agents. This is part of their business strategy to attract and retain agents. An agent's relationship with an insurer can also play a role. Agents who sell a high volume of policies for a specific company might earn higher commission rates. This is often structured as a bonus or tiered system. Market conditions and regulatory environments can also influence rates. Commission structures must comply with state insurance laws. These laws aim to ensure fairness and transparency. The type of agent you work with also impacts their compensation structure. There are two primary categories: captive agents and independent agents. Their business models differ significantly. Their commission rates and structure are set by their employing or contracting company. They may also receive a salary, benefits, or bonuses in addition to commissions. Their focus is selling that company's specific products. Independent agents, on the other hand, represent multiple insurance companies. They are not employees of any single insurer. They operate their own businesses or work for an independent agency. Independent agents earn commissions from whichever company the customer chooses. They have contracts with many different insurers. This allows them to offer a range of options to clients. Their income is solely commission-based from the various insurers they represent. They do not typically receive salaries or benefits from the insurance companies. Their compensation depends entirely on sales across multiple carriers. This difference in structure influences how they approach selling. A captive agent is incentivized to find the best fit within their single company's offerings. An independent agent is incentivized to find the best fit among the many companies they represent. While commissions are the main source, some agents may have other ways of earning income. These are less common or supplementary depending on the agent and their business model. Some agents may receive performance bonuses from insurance companies. These bonuses are often based on meeting specific sales targets or achieving certain levels of client retention. They reward high performance. In some cases, agents might charge direct fees for their services. This is less common for standard personal lines like auto and home insurance. It is more often seen in complex commercial insurance or consulting roles. Charging fees directly requires clear disclosure to the client. Regulations often govern when and how agents can charge fees instead of or in addition to commissions. This ensures transparency for the consumer. Some agents might also earn income from selling related financial products. This could include annuities, mutual funds, or other investment products if they are licensed to do so. This diversifies their income sources. However, for the typical consumer buying auto, home, or standard life insurance, the agent's income is almost exclusively derived from commissions paid by the insurance company. A common question is whether the agent's commission increases the cost of your policy. As mentioned earlier, the commission is built into the premium. You do not pay an extra fee directly to the agent on top of the premium. Insurance companies factor in distribution costs, including agent commissions, when setting premium rates. These costs are part of the overall business expense of acquiring and servicing policyholders. So, while the commission is part of the premium you pay, it's not an added charge you could avoid by buying directly. Even direct-to-consumer insurers have marketing and acquisition costs, which are factored into their premiums differently. The commission structure can create potential conflicts of interest. An agent earns more commission on policies with higher premiums. This might incentivize an agent to recommend a more expensive policy. The long-term success of an agent depends on satisfied clients who renew their policies. This renewal income provides stability. This incentivizes agents to build lasting relationships based on trust and appropriate recommendations. Regulations and ethical guidelines also play a role. Agents are required to act in the best interest of the client, or at least recommend suitable products. Professional standards guide their conduct. Knowing how agents are paid empowers you as a consumer. It allows you to engage with agents more effectively and make better decisions about your insurance. When comparing quotes, understand that different companies offer different commission rates. This doesn't necessarily mean one policy is better or worse, but it's part of the pricing structure. Focus on coverage, cost, and the insurer's reputation. Ask your agent questions about the policies they recommend. Understand why a particular policy or company is being suggested. A good agent will explain the coverage benefits and how it meets your needs, not just focus on price. If you are presented with multiple options, ask about the differences in coverage and cost. An independent agent can often show you quotes from several companies, illustrating the range of options available through them. Be aware that an agent's recommendation might be influenced by their compensation structure. This doesn't mean they're acting unethically, but it's a factor in the relationship. Your role is to ensure the recommendation aligns with your needs and budget. Understanding commissions helps you appreciate the agent's business model. They are running a business and need to earn income. This perspective can foster a more productive relationship. Agents offer expertise and guidance. Insurance policies can be complex. Agents help you understand different types of coverage, policy limits, deductibles, and exclusions. They translate complex terms into understandable language. They help assess your risks. A good agent will take the time to understand your specific situation, your home, your car, your family, your business. They help identify potential risks you might not have considered. Agents assist with the application process. They guide you through the paperwork and requirements for obtaining coverage. This can save you time and prevent errors. Crucially, agents can be invaluable advocates during the claims process. If you need to file a claim, your agent can guide you through the steps, explain what to expect, and sometimes intervene on your behalf with the insurance company. For many consumers, especially young adults and new homeowners navigating insurance for the first time, the advice and support of an agent are well worth the cost embedded in the premium. The commission compensates them for these services. Understanding how insurance agents make money is about gaining knowledge. It's not about assuming ill intent. It's about being an informed participant in the insurance transaction. By knowing about new business versus renewal commissions, varying rates, and different agent types, you can better interpret the advice you receive. You can ask more targeted questions. Use this knowledge to evaluate the recommendations made by agents. Ensure the proposed coverage meets your needs and fits your budget. Compare options based on value, not just price or an agent's suggestion. Ultimately, the goal is to make confident, informed decisions about your insurance coverage. Transparency about how agents are compensated is a key part of that process. It helps build a foundation of trust in your relationship with your agent and your insurance provider.